two traders. Same charts, same market, same pairs, same news. One is consistently profitable, the other is consistently losing, and the difference between them has nothing to do with their strategy, nothing to do with their indicators, nothing to do with how many YouTube videos they've watched. The difference is in how they think, how they behave, what they do when the market does something unexpected. Today, I'm going to show you exactly what that difference looks like. And more importantly, I'm going to show you which side of that line you're currently on. In the next 20 minutes, I'm going to walk you through 3 specific things that separate winning traders from losing ones. Not vague motivational stuff. Specific, real differences in behavior and mindset, backed by real trader stories. Each difference I show you, I'm also going to give you the exact habit to fix it. So by the end of this video, you will know exactly what you need to change to move from the losing side to the winning side. This is the most honest conversation about trading you'll have today. Let's get into it. Meet Bilal. Bilal opens his trading platform every morning at 8 a.m. Before even making tea, he sits down and immediately starts scanning every chart. Euro USD, GBP JPY, USDKD, AUD NAZD. He's looking for something, anything. He needs to find a trade. Why does he need to find a trade? Because not trading feels like missing out. Because other traders on social media posted 3 wins this morning already. Because sitting on the sidelines doesn't feel like trading. It feels like doing nothing. So John finds a setup. It's not perfect. The market isn't really doing much. There's no clear direction. But there's a candle that kind of looks like it might be going up. And the news is quiet, so maybe it'll move. He enters. What do you think happens? The market does nothing for an hour. Then it drifts against him. Not a big move, just slow, grinding pressure. He holds, he hopes. The market continues lower. He eventually exits at a loss. Not a big loss, but a loss. He does this 3 more times that day, all small losses. None of them catastrophic individually. But together, by end of day, he's down $180 from 4 trades that he forced. 4 trades that he manufactured from nothing. Now compare this to Mario. Mario opens his platform at the same time. He looks at the same charts. He sees the same conditions, and he makes one decision. There's no clear setup today. I'm going to wait. He closes his laptop. He comes back in the afternoon. The market still hasn't given him anything clean. He closes the platform again. He doesn't trade that day. His account is exactly where it was yesterday. No loss, no gain. And to most people, that sounds boring. That sounds like failure. But here's the truth. Mario just made $180 more than Bilal today. Not by trading, by not trading. When was the last time you chose not to trade because conditions weren't right? Most traders never do. And that one habit, the inability to wait, costs them more money than almost any bad strategy ever could. This behavior comes from something called action bias. Your brain is wired to believe that doing something is always better than doing nothing. In most areas of life, this is true. Work harder, move faster, take action. But in trading, it's one of the most dangerous instincts you have. There's also the FOMO problem, fear of missing out. You see the market moving and you feel like you should be part of it. You feel left out. You feel like while you're sitting on the sidelines, other traders are making money without you. And that feeling, that restless, anxious feeling, pushes you into trades that your logic knows are wrong. And then there's the identity trap. Many traders begin to associate themselves with the act of trading. I am a trader. Traders trade. So not trading feels like not being a trader. It feels like giving up your identity. And your brain will do a lot of irrational things to protect your identity. Can you see those patterns in yourself? The urgency to open a trade even when you know the setup isn't there. That's action bias at work. The discomfort of watching the market move while you're flat, that's FOMO. The feeling that sitting still is somehow failing, that's the identity trap. All 3 working together. All 3 costing you money. Winners redefine what doing the job well means. Losing traders think their job is to find a trade. Winning traders know their job is to wait for the right conditions and to do nothing when those conditions don't appear. Here's the practical fix. Write down your entry criteria, your specific, non-negotiable conditions that must exist before you enter any trade. Not "it looks good," not "my gut says yes." Specific criteria. For example, price must be at a key level. The session must be active. There must be a clear directional move on the higher time frame. Confirmation must appear on entry. Now, every time you want to enter a trade, you check it against that list. If all criteria are met, you trade. If even one is missing, you wait. No exceptions. No just this once. No, this one is close enough. Either all boxes are ticked or you don't enter. This feels restrictive at first. You will miss some trades. You'll watch setups you skip because of one missing criterion, and they'll work. That will be painful. But here's what you won't see. All the times a similar setup failed. All the losses you avoided by sticking to your criteria. The winners are visible. The saved losses are invisible. But they're real. There's another habit that winners use. They treat no trade days as wins. At the end of a day where they found nothing and traded nothing, they write in their journal, "Conditions unclear, no trade taken, capital preserved." They celebrate that. Because protecting your capital on bad days is exactly how you stay in the game on good days. Robert eventually made this change. He built a strict entry checklist. For 2 weeks, he didn't trade at all. Every day, something on his checklist wasn't met. At first, he felt frustrated. By the end of the second week, he felt calm. And on day 15, all conditions aligned on GBP/USD. He entered. The trade hit target. Clean. Confident. No anxiety. Just execution. That feeling. Entering a trade where every condition is right. Do you know that feeling? That's what waiting gives you. Clarity. Confidence. And a much higher probability of success. Winners don't trade more. They trade better. Build your entry criteria. Stick to them. Treat no trade days as capital preserved, not time wasted. Anna started trading 8 months ago. She's intelligent, hardworking. She genuinely wants to get better. But every morning when she sits down at her desk, the first thing she does is open her account balance. She checks the number. Then she checks yesterday's P&L. Then she checks this week's P&L. Before she's even looked at a single chart, she already knows exactly how much she's up or down. And that number, that balance, colors everything she does that day. On good days, she's relaxed, confident, maybe even a little reckless. On bad days, she's tense, second-guessing every decision, scared to pull the trigger on trades she'd normally take without hesitation. 1 week, she had 4 losing days in a row. Nothing unusual about the trades. Normal losses, within her risk rules. But she was down $340 for the week, and that number was eating her alive. She kept thinking about it, calculating how many winning trades she needed to get back to even. Recalculating, obsessing. On the 5th day, she forced 2 trades that weren't in her plan just to get some back. Both lost. She ended the week down $520, not because of bad analysis, because her focus on money destroyed her decision-making. Have you ever let your account balance change how you trade? Most traders do this without even realizing it. The balance becomes emotional fuel. A good balance makes them overconfident. A bad balance makes them fearful or reckless, and neither emotional state produces good trading. Why it happens? Here's the psychology. Money is deeply personal. It represents security, safety, status, freedom. So when your trading account balance changes, your brain doesn't just see numbers. It sees threats to your safety and your self-worth. A down day doesn't just mean you lost money. Emotionally, it feels like you failed. Like you're not good enough, like your dreams are getting further away. That emotional interpretation triggers the stress response. Cortisol rises, and under high cortisol, your brain's decision-making quality drops significantly. You start thinking short-term. You start looking for quick fixes. You stop following the process. Because the process feels too slow when you're in emotional pain, and you just want the bleeding to stop. There's also something called results-based thinking. Losing traders measure their success by the outcome of each trade. Win, good decision. Lose, bad decision. But that's completely wrong. A bad trade can win by luck. A good trade can lose by random market movement. The outcome of any single trade tells you almost nothing about whether you made the right decision. So what do winning traders measure instead? They measure process. Did I follow my entry criteria? Did I set my stop loss before entering? Did I stick to my 1% risk rule? Did I honor my exit plan? If yes, that was a good trade, regardless of whether it won or lost. That mental shift, from judging outcomes to judging decisions, changes everything. 2 specific habits, both simple, both powerful. Habit 1. Stop checking your balance every day. This sounds almost too simple, but the impact is significant. Hide the balance column if your platform allows it. Disable the daily P&L display. Check your overall balance once a week, on Sunday, not every morning before trading. Your goal for each trading session is not to make a certain amount of money. Your goal is to execute your plan flawlessly. The money will follow the process, but it won't follow the obsession with money itself. Habit 2. Grade your trades by process, not by profit. After every trade, ask yourself 5 questions. Did I follow my entry criteria exactly? Was my stop loss placed before entry? Was my risk within my 1% rule? Did I stick to my original target? Or did I exit early out of emotion? Would I take this exact trade again tomorrow? If the answer to all 5 is yes, that was a perfect trade, even if it lost. Because a trade can follow perfect process and still lose due to random market behavior. That's not failure. That's trading. If the answer to even one question is no, that's where your focus goes. Not on the money lost, on the process broken. Fix the process. The results will correct themselves over time. This is one of the hardest mental shifts in trading, because everything in our culture tells us, judge yourself by results. Your boss judges you by results. Your grades were results. Social media celebrates results. But trading doesn't work that way. Trading rewards consistency of process over long periods, not individual outcomes over short ones. Think about it this way. A surgeon doesn't define themselves by whether every patient recovers. Some patients have complications no one could predict, but a good surgeon follows best practices on every case. Over thousands of surgeries, that consistent process produces the best possible outcomes. Trading is the same. Follow the process on every trade. Trust it over time. Let the results emerge from the discipline, not from the desperation for quick money. Anna made this shift. She covered her balance display with a sticky note. She started grading each trade on process only. The first 2 weeks were uncomfortable. She had no idea if she was up or down, but she felt calmer, more focused, less reactive. When she uncovered her balance on Sunday of week 3, she was up for the month for the first time in 5 months, because she stopped chasing the money and started executing the plan. What would change in your trading if you couldn't see your balance for the next 30 days? Think about that seriously, because the answer might be more revealing than you expect. Stop measuring success by profit. Measure it by process. Did you follow your rules? That's the only question that matters. Losers quit after bad days. Winners review and return. Jack had his worst trading week ever in November. He lost 5 trades in a row. His account dropped from $3,000 to $2,400. He felt humiliated. He had told his friend he was going to be profitable by year end. He had told his family he was building a skill that would eventually replace his job income. And now, 5 losses in a row. He stopped trading for 6 weeks. He told himself it was a break to clear his head. But the truth was, he was avoiding the pain. He couldn't face going back to the platform. Every time he thought about trading, he felt a knot in his chest. Anxiety, shame. When he finally came back in January, he had lost 6 weeks of practice, 6 weeks of market time, 6 weeks of learning. And nothing about his underlying problem had been fixed. Because he hadn't reviewed what went wrong. He hadn't identified the pattern. He had just waited for the pain to fade. He made the same mistakes again. Different month, same errors. Because breaks without reflection don't fix anything, they just delay the same problem. Now let's look at what a winner does in the exact same situation. Thomas also had a bad week. Same month, similar losses. 5 losing trades. A countdown from 3,000 to 400,000. Same pain, same frustration. But Thomas didn't disappear. On Sunday, he opened his trading journal. He looked at all 5 losing trades, one by one, and he asked himself honest questions. Trade 1, was the setup valid when I entered? Yes. Market just moved against me. That's acceptable loss. Trade 2, did I follow my entry criteria? No, I entered early without confirmation. My mistake? Not the market. Trade 3, did I move my stop loss wider? Yes, I gave it more room because I didn't want to lose. That's the emotion trap. Trade 4, was I in the right session? No, I was trading during a low volume period. That's an error of judgment. Trade 5, did I trade immediately after trade 4's loss? Yes, I was chasing. That's revenge trading. So, out of 5 losing trades, 1 was a valid loss within his system. 4 were mistakes with specific, identifiable causes. Now Thomas had information, not just pain, information he could use to improve. He took 3 days off, not 6 weeks. 3 days to reset emotionally. Then he came back with a clear list of what to fix. He addressed his early entry problem first. He adjusted his criteria to require full candle confirmation before entry. In February, he had his best month ever. Not because the market got easier, because he understood his own errors and closed them one by one. Why it happens when traders avoid reviewing their bad days. It's almost always about self-protection. Looking honestly at your mistakes is psychologically uncomfortable. It challenges your self-image. It forces you to confront the reality that you made avoidable errors, and your brain doesn't like that. There's a concept called self-serving bias. When trades win, traders attribute it to their skill. When trades lose, they blame the market. The spread was too wide. The broker ran stops. News came out unexpectedly. The setup looked perfect. The market just behaved randomly. These explanations protect your ego, but they prevent growth. And then there's the avoidance loop. A bad day creates negative emotion. Thinking about it recreates that emotion. So your brain avoids thinking about it. But avoiding it means nothing gets analyzed, nothing gets fixed. And the same errors repeat, creating another bad day. More avoidance, more repeated errors. The loop continues indefinitely. How many of your losing trades were genuinely random market behavior? And how many were your own avoidable mistakes? Most traders, if they're honest, will find that a significant portion of their losses come from repeated patterns. The same mistakes made over and over again because they were never properly examined. The Sunday Review. This is the single most important habit difference between consistent traders and struggling ones. Every Sunday, before the new trading week begins, you sit down with your journal and you review every trade from the week. Not to judge yourself, not to beat yourself up, but to learn, with the same curiosity and honesty a scientist brings to reviewing an experiment. Here's the exact review process. For every trade, ask 4 questions. Question 1. Was my entry valid according to my criteria? If no, why did I enter? What emotion or thought pushed me in without a valid setup? Write it down. Question 2. Did I manage the trade according to my plan? Did I move my stop loss? Did I exit early? Did I hold past my target? Any deviation from the plan gets written down and examined. Question 3. What was the outcome? And was the outcome connected to my decision quality? A loss can be a good trade. A win can be a bad trade. Separate the decision quality from the result. Question 4. What is one specific thing I will do differently next week based on this review? Not 5 things. Not a complete overhaul of your system. One specific thing. This review process takes 30 to 45 minutes, and it is worth more than 5 hours of watching chart tutorials. Because it's personalized. It's about your specific errors, your specific emotional triggers, your specific repeated mistakes. No YouTube video can give you that. Only your own honest review can. There's something else that separates winners from losers in how they handle bad weeks. Winners understand something that most traders haven't accepted yet. Losing is part of the job. It's not a sign that you're bad at trading. It's not proof that you don't have what it takes. It's a built-in part of how markets work. Even the best traders in the world have losing weeks, losing months. The goal is not to eliminate losses. The goal is to learn from them, reduce the avoidable ones, and keep the unavoidable ones within your risk management rules. Losers treat losses as proof they don't belong in this market. Winners treat losses as data, as feedback, as the cost of doing business, as necessary tuition for the education this market provides. That one difference in perspective, the way you interpret a loss, might be the most defining characteristic separating the two groups. Jack eventually understood this. He started doing the Sunday review. His first few reviews were uncomfortable. He found the same mistake appearing in week after week. He was entering trades during low-volume conditions and getting stopped out by random price noise. Once he saw that pattern clearly, the fix was simple. He simply stopped trading in those low-volume windows. His losing rate dropped by almost 30% in 1 month. Not from a new strategy, from reviewing the old ones honestly. What pattern is hiding in your losing trades right now that you haven't looked for yet? The answer is in your journal. If you don't have a journal, start one this week, because the data you need to improve is already there. You just need to look at it honestly. After a bad week, don't disappear. Do the Sunday review. Ask honest questions. Find one thing to fix. Come back better, not just rested. Let's bring all of this together. 3 real differences between traders who win consistently and traders who stay stuck. Difference 1. How they treat waiting. Losing traders see waiting as doing nothing. Winning traders see waiting as one of their most powerful tools. They wait for clarity. They only trade when all their criteria are met. They celebrate no-trade days as capital protected. They never manufacture trades from boredom or FOMO. Patience is not a personality type for them. It's a trained skill. Difference 2. What they measure. Losing traders measure success by how much money they made or lost. That number controls their emotions, and their emotions destroy their decisions. Winning traders measure success by process. Did I follow my rules? That's the question. The money is a byproduct of consistently answering yes. Hide your balance. Grade your decisions. Trust the process over the profit. Difference 3. What they do after a bad week. Losing traders disappear. They avoid. They wait for the pain to fade without examining its cause. And then they return, making the same mistakes again. Winning traders review. They sit with the discomfort. They ask honest questions. They find the pattern in their errors. They make one specific change, and they come back better. Every single week. These aren't the differences between talented people and untalented ones. They're not about intelligence. They're not about how much capital you have. They're about daily choices, habits, small decisions repeated over weeks and months that compound into either consistent growth or continued stagnation. You already know which side you want to be on. The question is, which of these 3 habits are you starting to build this week? Pick one, just one. Start there. Build from there. Because the gap between winners and losers in trading is not filled overnight. It's filled one habit, one honest review, one disciplined decision at a time. That's what the work actually looks like. Not exciting, not glamorous, just consistent, honest, patient. That's the real strategy. That's what nobody tells you when they're showing you their profit screenshots on social media. If this video gave you something real, subscribe right now. Every week I put out content like this. No hype, no get-rich promises. Just honest, practical trading psychology for people who are serious about actually improving. And in the next video, I'm going to show you why your best trading days might actually be the most dangerous. We're going to talk about overconfidence, what it is, how it silently destroys accounts that were growing beautifully, and the exact mindset shift that protects you from it. That video could save you more money than any strategy video you'll ever watch. Subscribe and make sure you don't miss it. See you there.